Alrighty, guys, this week we're going to go into payroll. Um, in chapter 7, payroll, of course, is a typical, what we're talking as far as a typical business event. It's the same as a transaction, except for certain things. We have to know how to calculate the payroll, how to report the payroll, and payroll taxes. So it's not just the payroll itself. And there's certain things that we have to remember. States, the federal law says certain things about the payroll. The state says something certain about payroll, and there may be local laws about the payroll as well. So we have to go ahead and look into all of that because we've got taxes that have to be paid based on the individual's claim of whether they are married, single, married with children, head of household, the whole 9 yards, whether they decide to have insurance or not. So this is what we've got to do. So we're going to calculate their own earnings, gross earnings, what they made. Then we have to look at any withholding taxes and look at net pay. Prepare the checks, prepare the payroll register where we keep the information and update the earnings for each individual employee. So you know how we were showing that we were paying salaries or we were paying wages? Um, that's what we have to do now in detail. So we've been doing it on the journal and on the general journal, but now we have to do it on the payroll register as far as the details of what we're doing for each individual employee. So we report the payroll and payroll taxes, prepare W-2 forms or W-3, and then we also then prepare the quarterly reports and then the annual reports of what we've turned in. The reason for the quarterly and the annual reports is because of the fact that we also have to turn in the 1099s or the W-2s at the end of the year to show how much people made for their income tax, whether they paid enough into the government or not. So we have to calculate the pay, record it, record the payroll taxes based on the person, post to the accounts in the general ledger, and then report the payroll and payroll taxes as well, and then begin to prepare the financial statements. So we must be accurate. Any mistake in payroll affects both the company and the employee. Has to be on time because, of course, people need to get their paychecks. By the way, we don't know if we're going to get, if employees are going to get, the government employees are going to continue to get paychecks this Friday because of the government shutdown. The other thing also is that we have to make sure that we obey the law. We have to make sure about the federal, state, and local laws. And we also have to make sure that this data is kept confidential except for the people that are actually needing it. These are some of the terms that you're going to need to know: hourly or salary. Hourly employees get paid for the hours worked at a minimum wage usually. And that means that they're clocking in and clocking out. Whether they gain vacation time or not, they're clocking in and clocking out. Usually, typically, it's for hours worked on a 40-hour payroll, which is usually calculated at 8 hours a week times 5 days a week, which would give you your 40 hours. Whether that's throughout the week or includes weekends or not, that's the way it works. Now, the other thing also is that for hourly employees, in the health profession, for example, they may not only get paid hourly, but possibly overtime and differential pay. For those that work at night, like 3 to 11 or 11 to 7, they may get anywhere between 15 to 18% above their normal pay because they're working those during that time at night. Salaries are fixed. That means that whether you work 40 hours, 80 hours, 70 hours, 15 hours, you're going to get paid the same amount of money regardless. Okay, and it all works out because as a salary employee, yes, there's times that the week goes by pretty quickly and there's not a lot to do. There's always something to do. But you still get paid regardless. Pay period can start on any day of the week, but must end after a specific period of time. It can be daily. You can pay daily, bi-weekly, weekly, semi-monthly, monthly, quarterly, annually, depends. You can use different pay periods for different groups, hourly or salaried, okay? Gross earnings, that means the amount of hours you made regardless. If you worked 40 hours at a certain pay period, that's how much you made, okay? Overtime though, anything over 40 hours has to be computed according to the state and federal law, okay? The Fair Labor Standards Act says that it is the one that governs the overtime earnings, applies to employers involved in interstate commerce, which means doing businesses in more than one state. The other thing also, it pay is at least 1.5 times rate over the 40 hours worked. And we'll get into the calculation in a little bit. A work week is a 7-day or 160-hour period that can start at any time. Okay. So for example, here we go. We have for biweekly, 1 week, week 1 they work 44 hours. Week 2 they work 38 hours. So week 1, October the 19th, regular hours 4. Overtime hours were 4. Total hours 44. October 26th only worked 38, missing those 2 hours. Maybe they were sick. Overtime hours 0. Total hours again 38. So for the total hours it's 82, but overtime hours are 4 and your regular hours are 78. So these 78 hours, these that are here, are going to be calculated at whatever amount they're getting paid. These 4 hours are going to be paid at 1.5 times more, and then added to the pay period. Okay, so here we go. The pay rate is $11.40 for the 82 hours total with 4 hours of overtime pay. So here we go. Here we go with the $11.40 at a regular rate times 1.5 is equal to $17.10 for overtime rate. So this means that they're going to get paid for the 4 hours that they worked overtime, $17.10 for each hour over the 40 hours. So the regular pay at 78 hours was $11.40. The overtime hours were paid at $17.10. So here we go. We had $889.10 of regular earnings plus $68.40 of overtime earnings. So when you add these together, the gross earnings that they have was $957.60 for the gross earnings. Or you could do it a different way, but it's the same. However, I'm not going to go into this one. We're only going to be working out this way because it makes it much easier. Okay. And yes, you could do it a different way, but we're not going to do it. Okay. It's just too much of a hassle. This makes more sense to me. Federal income tax. Here is where we're withholding. That's a tax that you owe the federal government based on what you decided to go ahead and pay. Your W-4 goes ahead and is the allowance certificate. It's used to determine how much amount of taxes are going to be withheld, whether you're married or whether you have dependents or not. If you're just married, it's only 2 of you, or whether you're married and you have children, or whether you're single by yourself, or whether you're single and have kids. Different amount of money. This is what it looks like. So for Stephanie, here's what she's working out at. Notice that she only has one allowable allowance, which is herself. Okay, that's it. So, and it goes ahead and puts in her social security number. And of course, it's only one because she's single. So her amount of withholding is going to be different than anybody else. Oh, by the way, those with withholding tax rates change every year. Again, withholding is determined by marital status, number of allowances, gross pay, and pay period length. Okay? And usually you're going to see that in Circular E, Tax Employer's Guide. These are what they look like, the wage wage brackets uh, tables. So this is what we're looking at. And we can link to that Circular E if we need to. Okay, but this is what it looks like. The wages are at least this amount, but less than this. Now, don't get confused, because if they're this, but less than that, which means that it's 800, but up to 819. If it starts at 820, it's this amount for sure, but it's less than 839. Then you go with these concerning to how many allowances you've got that you're going to be claiming. Okay, 0, 1, 2, however many. Okay, that's what it looks like. Again, state income tax withholding. If your state goes ahead and withholds income tax, only in 2014, only Alaska, Florida, Nevada, South Dakota, and Texas, Washington, and Wyoming do not have a state income tax. Still in Texas, we do not have one. New Hampshire and Tennessee have income taxes, only on interest and dividends. The states have similar tables as the federal ones that are there. But so far, Texas, no state income taxes. Other income tax withholding are many cities and counties sometimes tax employee earnings as well, much like the federal income tax, but it may be fixed to a certain amount of money. But again, they have their own rules regarding payroll tax deposits and tax deposits as well. For Social Security taxes, in addition to any federal and state taxes. I know you're wondering, so am I bringing any money home? Yes or no? And again, it's based on how much money that you make. In 1935, a federal law called the Federal Insurance Contribution, or FICA, became effective, and employees are required to withhold certain amounts from employees' pays for Social Security. It's used to make the following payments: monthly retirement benefits for persons over 62, medical benefits for persons over 65, benefits for persons who have become disabled, and it also benefits families of deceased workers who were covered under this law. Okay. The tax is really two taxes. It's the Old Age Survivors and Disability, or OASDI, and Medicare. Each tax is calculated differently. And with Medicare, all wages are subject to the Medicare tax. Now I know this is like, I don't know what you're talking about. Don't worry about it. These are the taxes that we're going to have to take out of a person's payroll. And I'm going to show you how we're going to be doing that, okay? But we still have to go ahead and understand what's going on. So these are some of the percentages and the rates that employers and employees have to go ahead and contribute to Social Security. Now, the maximum security amount, we're going to be seeing that as well, how much we're going to be taking out. The other withholdings are if a person decides to take out medical insurance, if they have a savings plan, if they have a disability insurance, if they have union dues, if they're going to make charitable contributions. Those are other things that are taken out of your paycheck, if that's what you want, yes or no. Sometimes life insurance is also taken out. So here we're talking about net pay. Okay, we're going to stop here, and then I'm going to show you the next video. So this is what we're saying. Now remember, Stephanie made so much. She made $957.60. That's gross. Now, she had federal income tax based on her tax tables removed, state income tax, part of the Social Security tax that was taken out, part of the other Social Security tax that was taken out from Medicare, Medicaid. She also has a medical insurance. So her total deductions were $271.87. So when all of these deductions are taken out, then her net pay, her livable pay, which is how much she's got to live on for the next month, is $685.73. Well, actually, this is biweekly. So this is what she gets paid every 2 weeks. So this is how much money she went ahead and is coming home with. Okay? Now, hold on right there. If you need to go through it again so you can understand what's going on as far as the taxes, go through this video again. We're going to be doing the next one, part 2, in just a minute. So I'll see you on the flip side.